Welcome to the Internet History Podcast. I'm your host, Brian McCullough. Today, audience favorite Owen Thomas is back on the show, this time for an analysis episode. This is not so much a straight-up interview like we usually do, so much as it's a free-form discussion designed to help us, and to help me specifically, establish the context for the dot-com era, sort of similar to the Maggie Mehar episode from last month. One small bit of housekeeping before we get started. Next week's episode will be coming out Tuesday morning, not Monday morning as is usual. You'll learn why that is next week. In the meantime, please enjoy this conversation with Owen Thomas. Owen Thomas, thanks for coming back on the Internet History Podcast.
My pleasure. Thanks for having me back.
So, Owen, last episode that you were on, we were mostly talking about your career. I wanted to have you back on because I wanted to talk to you about maybe your career covering the dot-com era, and hopefully, bring some recollections about what that era was like from roughly 97 to the end of 2000. When you start really covering tech as a reporter, that's when you started at Red Herring, right?
That's right, in 1997.
And so Red Herring had been around for a while, even before the 90s, right?
No, Red Herring got its start in the early 90s.
Okay.
It actually was founded by Tony Perkins, who had started another similar magazine called Upside.
Mm-hmm.
He had some kind of falling out with his backers or partners. I forget the details, but he went off and started Red Herring. It was originally conceived of as more of a newsletter, like an industry information sheet.
Mm-hmm.
Ironically, given today's news, as we're talking, Oculus is holding a press event about the Oculus Rift.
Right.
I believe that first issue was about virtual reality. So everything old is new again. So this was some 22 years ago. We talk about virtual reality, talk about cloud computing, which is really just a reincarnation of client server from the 90s when that was big. Everything moves in cycles.
Mm-hmm.
And the technology improves, the words change, but many of the things you see people working on, they were working on in the dot-com era. People are buzzing about Instacart. Well, in the 90s we had Webvan.
Mm-hmm.
All of these things existed. They just weren't that good.
Right.
But people were trying, all these ideas.
Mm-hmm. So when you started at Red Herring as a reporter, your beat is Silicon Valley?
We styled ourselves as covering the business of technology and the technology of business.
Mm-hmm.
Our beat was really venture capital backed startups.
Mm-hmm.
The philosophy, especially for the website, was if it got venture capital, it's worth writing about.
Mm-hmm.
Which again, everything old is new again. That's the critique that people make of, say, TechCrunch or VentureBeat these days.
Right. Well, one of the things that I've been pointing out in episodes is that the dot-com era was really a compressed period of time. I mean, things like Netscape and Amazon and eBay, all these things start out in 95, but it's not until really 97 and 98 that all of a sudden everything's a dot-com. Everyone's like, well, we'll sell pet food online. We'll, do airline tickets online. All this stuff happens in this really compressed period of time, right at the end of the 90s. So this is the exact period you're covering. Was there a sense as a reporter that every week you go into work and there's yet another new story popping up all of a sudden? It's like whack-a-mole covering all these startups?
Oh yeah, I mean for a news hound, right? Technology has always been a great beat because by definition it's about the new. But there was definitely an endless drumbeat of news. And remember, we didn't have Twitter. Not all companies really had their head around email. I remember getting faxes at the Red Herring with press releases. Actually, I remember getting press releases in the mail, which boggled my mind. I mean, the sheer waste, especially sometimes people would FedEx me a press release. Um, because I guess they didn't trust email, but they trusted FedEx. Um, the Yeah, the volume definitely picked up. What I remember in '97 is that we would be lucky if we could find one venture-backed tech startup. A lot of venture capital firms back then were kind of hedged their bets. They would do 50% consumer, meaning kind of like fast food restaurants or mall retail chains, that kind of thing, and 50% tech, or less, like 25% information technology, which is what they would call internet startups back then.
Tech only funds were rare.
Yes, that was and it was even notable if someone was really specialized in tech.
What are some of the first companies that you remember covering? Some of the first startups specifically.
Oh gosh, in '97 it was all about the portals. It was Yahoo, Excite, Lycos. Those were the companies to cover. I think the very first story I remember filing for Red Herring was about layoffs in Excite's editorial department. And that sentence doesn't even make sense now. What's Excite?
Right.
Even talking about web portals is incredible.
Also, that brings to mind like another thought that I've had a lot, that it seemed like the types of startups came in cycles and in waves. And so from month to month, I remember, all of a sudden the news would be, okay, B2B is the new flavor of the month. There was a time period when B2C commerce was the flavor. And then all of a sudden the next month it would be, no, it's going to be healthcare is going to be transformed by tech. Do you remember that as well? That like, it was such a wide open world back then that every new idea that came down the pike, it was like, no, this is the bright, shiny new thing. All the startups are going to be doing this.
Oh yeah, I mean there was definitely a lot of trend chasing. I remember it, especially in business software, in B2B. There would be CRM, then there would be ERP, then there would be EMA. What's that? Enterprise Marketing Automation. It's what we would call Salesforce nowadays, right?
Right.
But it was a category, and when there was a new category, suddenly I would get 3 pitches at once for 3 different companies that were trying to own it, without any real sense that that it was worth owning.
What also, I mean, that idea of that an idea is out there, and then all of a sudden there are 13 startups that are all doing the same thing. Like our episode last week we talked to one of the founders of when.com that was, a web-based calendar startup. So, at the point when they launched, I found a list, there were literally 13 other startups doing web-based calendars. And the same thing would happen with, when there was web-based email and that sort of thing. So, as a report.
Oh yeah, I mean web-based email. That was a whole in the space of a few months. Lycos bought Whoware, Yahoo bought Rocketmail, and Microsoft most famously bought Hotmail. And so everyone suddenly checked that box for web-based email. And the thing is, like, where did it all go? I mean, arguably, Hotmail became the foundation of Microsoft's cloud business. For Yahoo, having that email actually became the login. It was a reason why you would have a Yahoo account. And yet they all got bought. They all got beat by Gmail, right?
Right. Also, as a reporter, I was going to ask, like, how do you, if all of a sudden there's a new category and there's 13 players in it, like, how do you figure out, I mean, I guess that's the game, is they're all trying to get your attention so that they can seem like they're the leading player in the space. But, like, how do you suss out who the real players are? Is it based on who's backing them, the VCs that are backing them, that sort of thing?
You know, I have a really strong belief about this. In the 90s, when I was first covering venture capital, the investor who backed a startup was a strong signal. Now I think there's so much venture capital and so many startups. It's just essentially noise. Like, it has no meaning that this company was backed by Sequoia, or that company was backed by Kleiner, or that company was backed by Andreessen Horowitz, or that company went through Y Combinator. I think it's all noise nowadays. I mean, it is the only meaning is kind of the social meaning attributed to it. The way I heard a great story the other day about how one of my colleagues actually got hit on at the Battery by a startup founder who said, "Well, you know, my startup's in Y Combinator," as if this was supposed to impress her. You know, I think I think they've devolved into brand names. You know, there's no real meaning to it. It's just arbitrary and random. Who gets a deal? Social proof has become such a disease that you know, really all you know about a startup is that their investors heard someone else wanted to invest in it, and so they're investing in it. And yet in the 90s, there was actually some signal there. There was some meaning. And it was interesting to try to suss that out. It was interesting to see XL Partners, for example, made a big bet on online video. Now, I don't think, by and large, they did really well on it. They had Real Networks, which went public, and I think XL did nicely off of that. But for the most part, they kind of stumbled, and they really didn't kind of revive their good name as a go-to firm until they invested in Facebook.
The sort of coming back to what you were just talking about you know, the guy bragging about his startup as like a, you know, a badge of honor or something. Like, do you remember when it started to get that gold rush mentality where people were coming out to the Valley and starting any old .com and imagining that in 16 months or something that they can IPO and be worth $100 million? Like, was there a feeling on the ground of, okay, all of a sudden everybody's here and it's greed is here?
I mean, it was definitely it was definitely happening in 99. In fact, that was part of my thinking in taking a job at Time Inc. I kind of wanted to, try something new, step back a little from the budding insanity. What I didn't count on is that I really missed San Francisco. There's something magical about the city beyond it being the heart of the tech industry, which is how most people know it or think of it now. And I ended up missing it, but I remember thinking, this can't last. Of course, I turned around and 1 year later moved back pretty much into the throat of the .com bust. So in March 2000, the NASDAQ hit its peak. Everyone talks about the NASDAQ crashing.
Right.
It was really like a slow motion implosion.
Right, over the course of about a year or 18 months or so.
Yeah.
But back to the feeling that, because one of my pet theories is that, the true signs of a bubble are when the charlatans start to show up. And, there were cases of startups that were outright frauds, but I'm also talking about the people that would start a company, raise a $10 million round, and then blow $5 million of that round on a launch party in Vegas or something like that. You know what I mean?
Well, that was the case with one of the big frauds. I think you're thinking of Pixelon.
Possibly, yeah.
which was just this hilarious story of an online video startup that had nothing, no technology, no deals. They threw this big launch party in Vegas, and that was pretty much their proof point that they were
A player.
Yeah,
Right.
that they were a player. But I think I think what's easy to forget now in the age of Amazon Web Services and all these other kind of plug and play get your company started services is it was legitimately really expensive to be on the internet at scale in the 90s. You would have to pretty much know someone and at, say, Sun Microsystems,
Right.
and beg them for a server that was actually capable of serving web pages without crashing immediately. And I remember crazy stories like Excite. Excite needed a new software license because there was by and large no open source software. So
Right.
they had to call the Tokyo office of Sun and buy I think a Solaris license. That was Sun's operating system, a Unix operating system akin to Linux but commercially sold. And they had to call Tokyo to buy it because they needed it right away. The Menlo Park headquarters was closed, and it was the only way to do it. Nowadays, this would just seem ridiculous because you would just go to your AWS dashboard and spin up a new instance and just go about your business. But we're talking tens of thousands of dollars for software license, hundreds of thousands of dollars per machine for servers. So you could easily blow millions of dollars before you've served one web page. And we're not even talking about salaries. And salaries probably now they would seem modest, but you were still paying a good amount if you could find them for web engineers. And you had to invent the wheel because it had not previously been invented. The other thing that was happening, especially in '99, is a lot of big companies were waking up to the web, and they needed a strategy, they needed a website, they needed e-commerce, and they needed it now. So you had all of these companies, Scient, Viant, March 1st, all of these. I think you would call them like digital agencies now, but they called themselves, all these fancy terms. I think systems integrators. They were essentially building websites, but it's kind of like having McKinsey build a website for you. Like it was very expensive, but you didn't have a choice. Right. Because there's no way you could hire the people with these web skills on your own, and there was no way you could you didn't have the people who could come up with a strategy. So Scient, Viant, all the rest would come up with a strategy and then actually execute it, and fast.
I think that's a good point. Like, in popular memory, we remember, the IPOs, but there's also so much money sloshing around because, like we said, you do a calendar startup, you get bought by Excite, or you get bought by Yahoo, or you get bought by AOL. But also at the same time, there's all this money sloshing around because suddenly everybody from Hallmark cards to GM to anything suddenly has to have some sort of a website, some sort of a digital strategy. And so all this money is sloshing around to try to make that happen all at once overnight.
Yeah. These companies were going public. Scient was founded in 1997 and went public in 99. I think their offering was only $60 million, which seems, it seems like such a small amount compared to the huge private rounds that companies are now raising.
Right.
But it was much easier to go public than then. It was, this was before Sarbanes-Oxley, before all the regulation came down. And the other thing is the big investment banks had all set up shop in San Francisco and Palo Alto, and they were just churning out these IPO documents left and right.
I was going to say that's a key point too, because I spoke to a Barron's reporter a couple weeks ago, and she made the point that at some point it's like the switch is flipped, and suddenly the banks need any company to IPO, because now they've gotten hooked on all these fees and the M&A and that sort of thing. And did you get a sense of that too? Like there comes a period when it's almost like Wall Street is lighting the fire of this madness as well.
Right, you've got a machine, and you need to stoke it with fuel. You need more product to sell, and there was absolutely individual investor demand. I think that's a big difference between then and now. Like you don't really hear people talking in the street about like, oh, I want to get in on the Uber IPO, say. I think I think there's a sense that that game's kind of rigged now, especially with the big private rounds.
Right.
You really don't have a way of getting in.
Right. Uber's not going to IPO for anything less than 100 million market cap, so you miss your chance to get that 100x or whatever return from just the IPO.
Yeah, I mean, people always hold up Pets.com as this like giant value destroying disaster, and the truth is, I think its total market value when it IPO'd was around 83 million.
Right.
So, if you go from 83 million to zero, I mean, that's bad for all the investors. But by the way, Amazon took most of that hit because they were the largest investor in Pets.com. And yes, like definitely some widows, orphans, and other public market investors got hurt in that IPO. But the destruction of value that happened in the dot-com bust, it was Oracle, it was Microsoft, it was Sun, definitely, it was Yahoo. Those were the companies that torched billions of dollars in shareholder equity.
This will be sort of a hard one, but what was the sense among either reporters or among the people in the startups that you're covering that, when we're looking back on it in retrospect, like inevitably, like, boy, I hope you went public before the bubble burst. I hope you cashed out your options before the bubble burst or something. In like, let's say 99, how much of a sense was there that people were walking on eggshells just waiting for the hammer to fall? Or was it the opposite? Did people really believe, no, this is different, this will never end, the music will never stop?
I think it took a long time for that to kind of sink in. The thing is, very few employees actually kind of got out with their equity. If you think about when these IPOs were happening, so let's say you work at Scient, and the company goes public in the middle of '99. It's the end of the year before you can even sell because of a lockup imposed on employee shares. And by the way, you were probably hired in January or March of '99, so you're not even going to vest your first tranche of shares until March 2000. Well, what happens in March 2000? The bust, and suddenly your options are underwater. So what do you do with them? Do you exercise them when the stock is trading at a lower price than your strike price? No, that's silly. Then you get laid off, and you've got 90 days to figure out what you do with your options. They're still underwater, and you haven't made a dime on this big promise of equity.
Well, and then you have companies like, let's say, the Globe, which, has a rocket IPO, but then for the remainder of its publicly traded life, it's just sort of a slow descent down. So like, if you're hired on, I'm joining the Globe the week after it IPOs, your options are never going to be anywhere, essentially.
Yeah, that's right. And I think that's it's. I guess we shouldn't really weep for all these kids with their with the free Odwalla and all the perks that they had, but they really, like, by and large, like, they did not make out in the dot-com bubble. Now, insiders definitely did. If you're a venture capital firm and you had it written up that you could immediately sell in the IPO, or flip your shares to your limited partners, then you were set.
Right. Well, and you wonder how many people actually were able to pull a Mark Cuban, and walk away as a billionaire just because you got the timing exactly right. It is such a compressed period of time at the end. So many companies IPO in 98, 99, and so there's not a big enough window for people to pull a Cuban, I guess.
Right. Yeah, and you have to get the timing right. I mean, Cuban didn't just get the timing right. He had really good financial advice on creating, I think it was collars that protected him from a crash in Yahoo stock, which in fact happened. Did not make him popular back at Yahoo headquarters, but it's not Mark Cuban's problem.
I've asked several people what, I'm feeling around for what the actual pin was that started to pop the bubble. And my own personal theory was that it was maybe ad rates starting to go down, because underpinning a lot of everything happening was always this idea that, the web was the next great advertising medium, and so that was underpinning so many startups that were advertising, the vicious cycle of the advertising. Do you have a recollection or a theory of what it was that started to really prick the bubble and started to make things turn?
So that theory is it's not quite right, because you didn't have the phenomenon that you have now, like in the Google era of ad rates being set by auction, being essentially driven by a market rate. They were sold the old-fashioned way, salespeople having drinks with media buyers, and and inking some big, like, year-long campaign. The ad deals that were being done is like Pets.com bidding against PetSmart and like the 5 other online pets retailers to be the anchor tenant of Yahoo Pets, to quote unquote power Yahoo Pets. In other words, turn Yahoo Pets into a big ad. And AOL and Yahoo and the other portals, to a lesser extent, were just going to the bank, because if you were a if you were a startup and you could say that you have this partnership with Yahoo, then that would be enough, or so the theory went, for you to get more investment and then go public. So it was really like all of these advertising deals being funded by venture capital in an attempt to get more investment, either more venture capital or public market money. And so once you pulled out the venture capital infusion that was going in, suddenly CNET, Yahoo, all of these folks saw their business just fizzle up, because they weren't real ads. They weren't ads trying to gain market share, sell products,
right?
Or what have you. They were ads being purchased to um, drive appearances. Um, and often they were, like they were very circular. Like NBC invested in a search engine called Snap, and renamed it NBCI, NBC Internet, and they essentially pumped all this advertising into it, so it could show that it was it was getting all of this money in, but it was all fake dollars because it was NBC paying NBC essentially.
Well, so what you're saying is that it's almost like the gravy train sort of exhausted itself at some point, and then since the fire hose was so strong that any tapering down all of a sudden caused everything to collapse.
Yeah, and the only thing that fixed it was Google coming along and creating this way to buy ads that was very cheap and simple. And so, mom and pop stores could buy ads.
Right. Well, and then all of a sudden, because I remember this clearly, that there was a time again when you could do a startup and say, "Oh, we'll make our money with the hosting the AdSense," like creating a viable marketplace for advertising again.
Yeah, I mean, in both directions, like funding, making it simple to buy ads, making it simple to sell ads. And that picked up a lot of latent demand. Like these are folks who would never buy TV ads, would never buy magazine ads, right? Because it's too expensive, it's too complicated. It's just not, it's not realistically going to happen. So that actually brought like new demand into the system. And then, when people started seeing like how effective these online ads were, you started having bigger companies say, "Oh, like people are searching for, Louis Vuitton. Maybe I should buy a Google ad and get out in front of them." And you started having big brands come back to the internet after having been burned by buying banner ads in the wild 90s.
A couple more recollections. I remember really clearly having dinner with some friends that worked at startups in New York and Silicon Alley, and having dinner and then saying, "Oh man, it was such a tough week at work this week because it came down from on high. We've got to make money." This just spending has got to stop, and all of a sudden we've got to start getting in the black. And when I spoke to the Barron's reporter, she said a similar thing. Like her theory was that at some point, what really caused the bubble to burst was Wall Street just got fed up and was like, we're tired of giving all these startups enough rope. Okay, we need to start getting a return now. Do you remember a period like that happening when all of a sudden the switch was hit and okay, the music's off and you got to find a chair?
Well, it's funny that you mentioned Barron's because it was famously a Barron's cover story that called bullshit on especially e-commerce startups.
Amazon in particular too at the time.
Amazon.bomb.
Right.
So I think they were probably wrong about Amazon, right about every other e-commerce startup. I mean, like none of these are around, right? eToys, Cosmo, Newegg, is that still around?
I think it is, yeah.
Buy.com.
Right.
I mean, a lot of these names have come back under some, under different ownership, but they just blew up and fizzled away in the 90s. So I think that Barron's cover story definitely started the conversation, but I don't think it was as much pressure from Wall Street that you need to start showing profit. It was just a kind of a failure of the collective suspension of disbelief all at once. It was really just kind of market psychology saying, saying, "Oh my gosh, like I'm not going to find someone to flip this, to flip the stock to." When you started having IPOs fizzle, so you didn't have this enormous first day pop, that hurt the next IPO. It was entirely driven, as far as I could tell, by market psychology rather than any kind of reliance on like actual metrics. I mean, Pets.com was losing money hand over fist, and the hilarious thing, I did an analysis, and what I discovered is that the more Pets.com spent on marketing, the less traffic it got to its website. They were inversely correlated. And I mean, it makes sense if you think about it. Pets.com was buying TV ads. So in 99, 2000, the majority of consumers weren't even online. If they were online, how many of those people have any experience buying stuff online? Of those people, how many are pet owners? It was incredibly untargeted, and it's almost inconceivable to us today, to imagine an advertising campaign like that. Well, of course you would target like pet websites, and you would use Facebook ads, and target it specifically. Like, I'm sure pet owners are a category you can buy on Facebook and Twitter, and and the like. But we didn't have any of that advertising technology. So in Pets.com's defense, it was kind of the only option to reach a bunch of people. It just made no economic sense at all to do that.
Well, finally, we should probably say a little bit about the bust and what came after, because you go back to Business 2.0, and so you're essentially there for the nuclear winter, as it were. So all of your contacts, all these people that you've been covering, where are they all of a sudden in 2001, 2002, and what sort of stories now are you covering? Because I sort of have a memory of, there was this vague sense of, yeah, well, that fad is over, but of course we know it wasn't. So what was the environment like right in the nuclear winter, as it were?
Well, it was definitely tough. I remember in 2002, 2003, we kind of redefined the magazine around business opportunity and innovation wherever we could find it. So that might be, like at big companies, and it might be military contractors. It's like it was a boom time for these contractors, and so we even looked at those. We were covering kind of the nascent real estate bubble. The good thing for us is that Web 2.0 actually came along fairly quickly. So we had one of the first stories about Flickr. We were covering towards the end there.
Friendster is 2002, I think. Maybe I'm misremembering that. 2002, 2003.
Yeah, so there were there were these little companies popping up who we could write about, but it was it was definitely tough, and we actually one of our writers, Paul Sloan, made a beat out of domain name speculation. Mm. So you had all of these folks who had snapped up domain names during the bubble, and they were kind of stuck with them, and they wanted to figure out how to make money with them some way, somehow. So these were a lot of the folks who were buying AdSense ads back in the day.
Right, I remember that. So that you would just park it, and then whatever residual traffic came through, with keyword based and that sort of thing.
Yeah, and so we would talk to these folks and kind of figure out how they were making money, and when no one else was. But yeah, it was definitely an interesting time, and it was a challenge of like, what are we going to write about, or what are we going to find? You definitely had that B2B mania, um, and and you definitely had a lot of startups that you never heard much from, because it was very hard to exit, right?
Right.
during during that whole time. There were not a ton of IPOs. Google, though,
Right.
was Google and
Quietly killing it.
yeah, and so there were, like, we wrote about the Google bus, long before anyone else. We had our ear to the ground, so we wrote about this kind of quirky hippy dippy program Google had to save the commute. It wasn't even about traffic back then, because you could sail down 101 to Mountain View. But they wanted a more environmental way of getting to work. So yeah, it was definitely tough to find stories. I mean, PayPal was one that I kind of was a company I paid a lot of attention to, and it's funny that they're still around, and it's funny that they're about to spin out and be a public company again. They had this epic battle with eBay, and then you blink your eyes and they they sold out.
Right.
But yeah, that was a challenge, but it was interesting, and I'd say there were also a lot of people who were grateful that we were around to cover technology at all.
Right.
Because remember, like, by that point, industry standard was gone, the red herring was gone. There were Fortune and Business Week, even the New York Times and Wall Street Journal were paying far less attention to Silicon Valley. So we had we had a good chance to tell stories that other people weren't paying attention to.
Okay, final question, and then I swear I'll let you go. But play everyone's favorite parlor game with me real quick, especially based on what we've just been talking about. Compared to the 90s, are we in a bubble right now in tech?
I don't think we're in a bubble of the same type or with the same consequences. I mean, when the 90s .com bubble burst, the damage was widespread, right? You had everyone's 401k in tech stocks, because if your mutual fund manager was not invested in tech stocks, then he was probably losing his job. If you were an analyst and you weren't bullish on tech stocks, you'd probably lost your job at that point. So everyone had a stake in the bubble. These days, if Uber were to just somehow hit a ditch and lose its enormous valuation, maybe go out of business. I don't know what that scenario is. Who would really be hurt?
Right. That's what I see too. Yeah.
Not its early investors, because they've already sold out to these private equity funds. The private equity funds would take a hit, but honestly, like, they've got their bets spread all over the place, and there is so much money sloshing around. I think that's a macroeconomic factor you really have to get your head around, which is that there is a lot of excess capital looking for a home. And so it finds its way into these funds, and from there it finds its way into tech startups, because honestly, like, what are you going to do? Put it in a bank? I think some banks are even paying negative interest at this point, meaning they're charging you money to leave your money in there. You don't have a lot of good options for any kind of growth investment. So we're definitely not, if we're in a bubble, we're not in the same bubble. and it won't have the same consequences. Um, but I think, is it dangerous? I mean, what it's doing to real estate prices in the Bay Area is very clear.
Mm-hmm.
And that's absolutely driven by salaries. Like, people see the salaries people make in tech. There aren't a lot of opportunities um, in other fields that are anything close to close to that in terms of like how junior you can be and get a job, and how quickly you can rise up. So of course people are moving in and chasing that opportunity. Um, and I think that's dangerous in terms of San Francisco having a balanced economy. That said, at the same time, even if you look at the real estate bubble, the numbers, the employment in the tech sector doesn't really seem like it's enough to tip prices as strongly as we've seen. So so I think there are other reasons that probably have a lot to do with foreign investment in real estate. You definitely see it in London. You see it in San Francisco and New York. And again, it comes down to all this money kind of sloshing around. And that's not a phenomenon of tech. That's a macroeconomic phenomenon. But does it affect the technology sector? Absolutely. And how does it all play out? It's hard to say. But I think if you are, if you're the CEO of a tech company, I would be thinking long and hard about interest rates. I'd be thinking long and hard about, unrest in various parts of the world, the stability of various governments. It's a lot to worry about, and it's a very different question from, are we going to keep finding greater fools to pick up this latest e-commerce IPO?
Before I let you go, did you want to tell us anything? Since we last spoke with you, you've got a new job. You're at Wearable World now, and what are you guys doing at Wearable World right now?
Well, so it's not a new job, but
Okay.
I am working for a new owner. So Wearable World bought ReadWrite in February,
Mm-hmm.
and so Wearable World is a startup incubator, and I know cue the warning klaxons. And we also run events, and now we have a media business too in ReadWrite. It hasn't really changed what we do for our readers, but
Mm-hmm.
it's I'd say what's interesting is Wearable World is primarily a hardware incubator, and that brings a kind of different focus than say just an incubator that's pumping out mobile apps. Like, you have to actually make the hardware. You have to
Mm-hmm.
design it correctly. You have to be able to manufacture it at scale and at the right cost. The so there's a reality to hardware that I think is sometimes more difficult to find in say the software realm. Um, But so it's great to learn from these hardware entrepreneurs, and it's great to kind of get back to some of the technology I feel like we lost sight of in the internet bubble. It's great to talk about chips and and radios and
Actual widgets.
actual widgets, like stuff that does stuff. And then it all ties back to internet software and services, right? It doesn't. Hardware doesn't really function unless it's connected. But I think that's something that makes it a bit of a different world nowadays. We have folks like Fitbit and Pebble who are producing real devices, and I think that too makes it less of a bubble. People are actually putting money down for real goods, and they're not just betting that someone else is going to value this this share certificate more highly than they did.
Well, Owen Thomas, I'm going to let you go, but thank you so much for helping us frame this and giving us the context, and also helping me frame it and giving me the context. It's useful to bat around all these ideas and try to get it right what the dot-com bubble really was.
Absolutely, my pleasure.
If this is the first time you're listening to this podcast, please subscribe to us on your podcast app of choice. There's plenty more great internet history where that came from. And if you're a longtime listener, then you know what to do to help us out. Rate and review us on iTunes. Because iTunes gives credit to reviews and ratings, and the more great reviews we get, the more people will discover us. As always, there's more info on our website, www.internethistorypodcast.com. The show's Twitter handle is @NetHistoryPod, and my personal Twitter is @BrianMCC. Thanks for listening.